Welcome back to the Deep Dive. Today, we are taking a look at a topic that, it essentially runs the world economy, but most people think is just data entry.
Mm,
We're talking about SAP SD sales and distribution. And I want to start by addressing the elephant in the room,
which is?
boredom. I think when people hear sales and distribution, they picture someone in a headset, staring at a gray screen, just typing 100 widgets over and over.
Right.
But the research we're diving into today argues that if you think SD is just about typing orders, you are missing the entire point of enterprise resource planning.
You absolutely are. That perspective, that idea that it's just a typing exercise is what we call the junior consultant view.
The happy path.
Exactly. It's the happy path. Click here, type there, save, get a coffee. But today we're trying to get you, the listener, to the senior consultant mindset. Because at that level, SD isn't data entry at all. It is the commercial nerve center of the entire corporation.
Nerve center is a strong term. It implies it controls the whole body.
It's accurate, though. Think about it. SD is the architecture that determines how a company actually captures value. It dictates how products move, how revenue is recognized, and ultimately, whether the business is profitable or just busy.
So we aren't just talking about software configuration today. We're talking about process orchestration.
That's the perfect term for it.
So that's our mission for this deep dive. We're
Yeah.
going to move beyond the transaction codes, the VA01s, the VS01s that everyone memorizes, and look at the hidden architecture. We've got a huge stack of notes here covering the organizational structure, which is like the skeleton,
Right.
then the master data, which is the muscle, and then all the governance rules that keep the whole thing from collapsing.
And we really need to talk about why things break. Because usually when SD breaks, it's not actually an SD problem. It's a communication problem disguised as a software bug.
Okay, let's start right there. Segment 1, the commercial nerve center. The notes emphasize that SD forces a business to stop being vague. You can't just say, we sold some stuff to Bob.
Exactly. In the real world, selling stuff to Bob is a perfectly fine sentence. In SAP, it's meaningless. It's gibberish. The system forces you to answer 5 questions with absolute brutal precision. First, who is the customer?
And we'll get into this, but Bob isn't enough.
Not even close. Is Bob paying? Is Bob receiving the goods? Is Bob just the contact person who negotiated the deal?
Because those could be 3 different entities.
Precisely. Second question, what are we selling? Is it a physical box on a shelf? Is it a service, like consulting hours? Is it a warranty? Is it a third-party product we don't even touch?
Third question, how is it getting there?
Right. Which plant is it coming from? Which specific truck route is it taking?
And fourth, when does ownership transfer? This sounds like a legal one.
Oh, it's huge for the legal department. Does the customer own it the second the truck leaves our dock, or only when it hits their doorstep? That defines who pays for insurance if it crashes on the highway.
And the fifth one, which I assume is the CFO's favorite question.
Where does the money go?
Where is the money?
It's exactly. Which general ledger account captures the revenue? If you can't answer those 5 questions systematically, you don't have a business, you have a hobby. And this is all built on what you mentioned earlier, the integration reality.
I saw a statistic in the source material that just blew my mind. It said 70% of SD issues aren't actually SD issues at all.
It's a classic scenario. Picture this. A sales rep is screaming, I can't create the invoice. The system is broken. SD is down.
Okay.
A junior consultant logs in, starts checking the billing configuration, looking for a bug in the code, frantically searching for what changed.
But a senior consultant looks elsewhere.
A senior consultant knows SD is the net that catches everything. It sits right in the intersection. It connects to materials management, do we have the stock? To production planning, did we make it? And to finance, are we allowed to book the revenue? So usually the invoice is blocked because finance locked the GL account or the customer hit their credit limit.
It's a spider web, so finance twitches a thread over here.
The sales order freezes over there. Precisely. If you don't understand those connections, you're just guessing. You're treating symptoms, not the disease.
Okay, so you need a rigid structure to hold it all together. Let's move to segment 2, the skeleton, the organizational structure.
This is where you build the world before you can live in it.
The notes use a waterfall model to explain this, which I found really helpful.
Yeah.
Can you walk us down this waterfall?
Sure. Imagine water cascading from the top. At the very highest level, you have the legal layer. This is the company code.
Okay.
Think of it as the bucket at the bottom of the waterfall that catches all the money. It's a specific legal entity, like Samsung Electronics USA Inc.
So the company code is the bucket. It's what produces the balance sheet, what's pouring into it.
The sales organization, this is the commercial layer. This is the team effectively throwing the money into the bucket. You might have a domestic sales org and an export sales org. Different teams, different strategies, but they all feed the same legal entity.
Got it. So sales org is below company code. What's next?
The strategy layer, the distribution channel. Think of this as the pipe the money flows through. Are we selling wholesale, retail, direct to consumer via e-commerce?
And this matters because of pricing.
Pricing, minimum order quantities, legal terms, everything. If I buy a laptop through the wholesale pipe, I expect a bulk discount. If I buy it through the retail pipe, I pay full price. The system has to know which pipe we're using.
That makes perfect sense.
Yeah.
Okay, then we have the product layer.
The division, this is the flavor of the money. Are we selling high-tech electronics or spare parts? It separates the business line so you can run profitability analysis later.
You want to know if the motorcycles are making money or if you're just surviving on t-shirts.
You got it. And finally, at the bottom, the physical layer.
The actual warehouse.
The plant and the shipping point. The physical door the box leaves from.
Now, the sources mention something called the Holy Trinity of SD, the sales area. This term comes up constantly.
It is the absolute requirement. You cannot create a single sales order in SAP without a sales area. It's the unique combination of those middle three layers. Sales org plus distribution channel plus division.
So it defines the rules of engagement for one transaction.
Exactly. U.S. sales, wholesale electronics is one sales area. U.S. sales, retail electronics is a totally different one. They're like parallel universes.
And customer data in one doesn't automatically exist in the other.
Nope. Just because you can sell to Walmart in the wholesale channel doesn't mean you can sell to them in the e-commerce channel unless you specifically extend the data.
The notes warn about a specific trap here, the cross-company trap. This sounds like a headache.
Oh, it's a career killer if you miss it in the design phase. Imagine you have a sales org in the U.S. that's company code A, but the customer wants a product that's sitting in a plant in Canada. That's company code B.
A junior consultant might just say, okay, assign the Canadian plant to the U.S. sales org. Problem solved.
And they would be breaking the law.
How so?
Because you're mixing the books. The U.S. entity can't just sell goods that belong to the Canadian entity. If you do that, the revenue lands in the U.S. bucket, but the inventory disappears from the Canadian bucket. The books don't balance.
And the tax authorities are not going to be happy.
Not at all. So the system has to trigger an intercompany sale. It performs this magic trick where it automatically generates an internal invoice. Canada bills the U.S., and then the U.S. bills the final customer.
Wow. So one checkbox in the configuration determines whether you're doing a simple sale or a complex international tax event.
That's it. Get it wrong, and goods leave the building, but the money never lands correctly.
Speaking of goods leaving the building, there's a golden rule of logistics in the notes. One delivery equals one shipping point.
This is all about respecting physical reality. Let's say you're a chemical company. You have a liquid dock with pipes and tankers on one side of campus.
Okay.
And on the other side, you have a solid dock for boxes and pallets.
And a customer orders 500 gallons of acid and 10 boxes of safety gloves.
The system will split that into two separate deliveries. It has to. You can't load the acid and the gloves onto the same truck at the same moment because they're leaving from two physically different locations.
It forces the paperwork to match the geography.
The system respects physics above all else. If you can't be in two places at once, you get two delivery notes.
Okay, so that's the skeleton, the rigid structure. Now let's talk about the muscle, master data. The source material makes a bold claim here. 80% of production issues are master data errors.
That number feels low, honestly. It's probably higher. You can have the most beautifully configured system in the world, but if your data is garbage, the process fails on day one.
Let's start with the customer master. We hinted at this. Bob isn't just one record.
No, the customer is a 3D puzzle. It has three distinct views. Level 1 is general data. This is global. Name, address, language.
And if you mess this up?
If the address is wrong, route determination fails. The system literally can't figure out which truck to put it on because it doesn't know where it's going.
Okay, level 2 is company code data,
Mhm.
the financial view.
This is the link to the CFO. The most critical field here is the reconciliation account. This tells the system, when we sell to Bob, which bucket in the general ledger shows he owes us money. If you miss this, you can ship the goods, but you can never, ever bill him.
The system just screams at you.
It just stops. And level 3 is sales area data, the commercial view. This is where you set pricing, shipping conditions, all of that.
Bob can have different rules for different sales areas.
Exactly. In the wholesale channel, he might pay for freight. In the retail channel, he might get free shipping. The master data allows for that nuance.
Now let's switch to the material master.
Yeah.
There's one field here the notes say is maybe the most important field in the entire SD module, the item category group.
Yes. If you remember nothing else from this deep dive, remember this field. The item category group tells the system what the thing actually is. Is it a standard product we stock? Is it a service, like consulting hours, which has no weight?
Yeah.
Or is it a third-party item?
Why is that so critical?
Because it dictates the behavior of the entire chain. If I accidentally label consulting hours as a standard stock item, the system is going to try to check availability in the warehouse.
It's going to look for a box of hours.
And it won't find them, so it will say out of stock and block the sale. You literally can't sell your services because the system thinks they're missing from inventory.
One tiny field breaks everything.
Pricing, delivery, and billing, all at once.
Wow. Okay, one more piece of master data I want to touch on. The CMIR Customer Material Info Record. The notes call it the ultimate override.
The CMIR is a consultant's superpower. Here's the scenario. You sell Pentium Processor 500. Your customer, say Intel, calls it Chip X. They send you an electronic order for Chip X.
And normally the system would just reject that. Unknown material.
Right. But the CMIR is a translator. It tells the system, for this customer, Chip X equals Pentium Processor 500. But it does more. It can override behavior.
Like what?
Let's say all chips normally ship from San Francisco, but for Intel, and only Intel, we promise to ship from Portland to save time. You can set that rule in the CMIR. It overrides the standard logic just for that one relationship.
It's powerful. But with great power comes great data governance headaches.
Huge headaches. Governance is basically war in a project. Sales wants to just sell. Finance needs tax codes. Logistics needs loading groups. A good consultant audits the data before they ever touch configuration.
Let's move to segment 4, physical reality, stock posting. The key takeaway here is SD consumes reality. It doesn't create it.
That is the mantra. SD makes promises, but we rely on materials management to actually provide the goods. If the warehouse is empty, ST is just a very expensive typewriter.
The notes highlight the stock transport order, or STO, as a major source of confusion. This is just moving goods from your own plant A to your own plant B. Why is this so hard?
Because it forces two different modules to dance together. It starts as a purchase order in Plant B wants to buy from Plant A, then it creates a delivery in SD. Plant A is shipping to Plant B.
So you pick it, pack it, ship it.
And then this is the trap. You have stock in transit.
The limbo state.
Yes. The truck leaves Plant A. The stock is deducted from Plant A's inventory, but it hasn't arrived at Plan B yet. Where is it?
It's on the highway.
Right. But from an accounting perspective, it's floating. You cannot sell it. It's not available. But users run a report, see the total global stock, and say, we have 10,000 units. Sell them.
Forgetting that 2,000 of those are on a truck.
Exactly. A good consultant has to configure the availability check to ignore that floating stock, or you're going to disappoint a lot of customers. You have to protect the sales team from their own optimism.
Now, I have to ask about God mode. The notes mention movement types 561 and 501. This sounds dangerous.
It is extremely dangerous. These are movement types that create stock out of thin air. 561 is used when you first go live. You upload your legacy inventory. You're telling the system, trust me, we have 50 widgets. There's no purchase order, no manufacturing record, just here it is.
And 501.
Receipt without a PO. It's for when a vendor drops off goods, but the paperwork hasn't been done yet.
Why is this a problem?
Because in a high-pressure warehouse, a manager who's short on stock might be tempted to use 501 to find stock that doesn't actually exist.
Just to unblock the system for a VIP customer.
Yes. They think, I'll fix the paperwork later, but they never do. Now you've shipped goods you didn't technically have, and the accounting variances are a nightmare.
So, restrict access to God mode.
Lock it down. Only the warehouse manager should have the key, and even then, only on Tuesdays.
Okay, we're in the home stretch here. Segment 5, the DNA, customer account groups.
This is one of my favorite topics because it seems so boring, but it controls everything. An account group isn't just a label. It is a control framework. It dictates which fields are mandatory and what that partner can actually do.
The notes use a DNA analogy. Let's break down the main ones. 001, the sold to.
The sold to has the DNA of a buyer. They place the order. Therefore, the system demands they have a sales area and pricing details. You try to save one without that, the system blocks you.
002, the ship to.
The The DNA of a destination. It needs a physical address and a transportation zone so we can route the truck. Does it need a credit limit? No. A warehouse doesn't pay bills.
Right.
And 003, the payer. The DNA of a wallet. It needs banking details, tax IDs, a link to credit management.
And the design principle is one role equals one account group. Why can't we just have one super customer group that does it all?
Because of the mandatory fields. Let's say tax law requires a VAT ID for the payer. So you make that field mandatory in the configuration for the payer group.
Okay.
But if you use that same account group for a ship to a loading dock, the user creating that record is now forced to enter a VAT ID. The loading dock doesn't have one, so the user types in 12345 just to get past the error.
And now your audit data is corrupt.
Exactly. By separating the DNA, you can enforce strict rules on the pair without annoying the people creating ship-tos.
Finally, we have the guest checkout of SAP, the one-time customer or CPD account.
Useful, but hated by auditors.
Why?
Because it bypasses the master data controls. For a CPD account, you type the name and address directly onto the sales order itself. Mickey Mouse, 123 Disney Lane.
I see the risk. You could type in a sanctioned entity or a fake company to funnel goods out the back door.
It's a massive blind spot. The system's standard checks like, is this customer blocked? They don't work as well because there's no master record to block. It's just text on an order.
So we've covered the nerve center, the skeleton, the muscle, reality, and the DNA. When you pull back, the role of an SAP SD consultant is pretty profound.
It is. The source notes describe the consultant as a translator. Your job is to take a business need. We want to sell widgets to France, but build them in Switzerland, and translate that into SAP logic.
Okay, that requires an export sales org, a specific Incoterm, and a payer in a different currency.
You've got it. And if you translate it well...
The business scales effortlessly.
Right. You launch a new product, the system just knows what to do, the logic handles the complexity.
And if you translate it poorly?
Then chaos looks like automation. You are just making mistakes at the speed of light, sending the wrong invoices to the wrong people automatically thousands of times a day.
That is a terrifying thought. But I want to wrap up with one concept from the notes that I think defines that senior mindset. The idea of master data as behavior switches.
This is the big takeaway. In a live system, you rarely change the configuration. You aren't going to rebuild your org structure on a Tuesday. That's a 6-month project.
But master data changes every minute.
Exactly. A new customer, a new material, a new price. And every time you create a master record, you are programming the business. Change the item category group. You just change the logistics process for that product. Change the customer account group. You just change the financial compliance for that partner.
So if you want to control the daily reality of the business, you don't do it through code.
No, you do it through master data governance. That is the steering wheel of the enterprise.
That puts a whole new spin on data entry. For everyone listening, don't just memorize the transaction codes. Look for the skeleton and the muscle. That's where the real work happens. Thanks for diving in with us.
See you next time.